Thank God for the night, because yesterday was really like, the worst days that we've seen in about almost 7 months, and thank God it ended. And I hope you don't see a repeat of that kind of manic Monday that we had yesterday.
You just wanted to ring the closing bell and go home.
Yeah, really.
Everybody was waiting for 3:30. If it was 4 o'clock
But it won't
markets,
happen till the market sunk to the lowest point of the day.
it was a tough Monday, but that tough Monday has a very strong backdrop. And the backdrop was that we got hit locally, globally, HNI crowd, selling, which is, when I say selling, was a function of not so much so any adverse event locally or globally. It was about the positioning of the market where a retest button has been pressed. So the positioning of the market, what it was, let's say, a month ago versus what it is now, the confidence level and commitment level in terms of buy high and sell high, that spirit is broken. And if one looks at the institutional data yesterday, the institutional data on Monday was not that scary. DI versus FI, add back that cash market activity and the FNO market activity, the net number was not bad. So hua kya? Who sold? And I think that is where this entire setup of ultra HNI, ultra retail, strong retail investors, they've gone into some kind of a panic mode. So the commitment levels are getting reduced. Selling is causing more like a snowball effect, and that explains that in last couple of days there has been excruciating pain in some of the rank mid-cap stocks. Some of the popular themes like solar, manufacturing, banking, defense, they've reversed. So we've just set the tone of why markets fell and what was the impact of the carnage. There is an absolute sea of red. Nobody was expecting this kind of a beginning. And more than the Nifty, just look at the small cap index, guys. It's not the Nifty. Who cares? It is a small cap index which has fallen 10% in 2 sessions. And that's where the panic and that's where the unwinding seems to be happening. So the mood point is that the template with which everyone was working for, that has changed. Commitment levels have been reducing. I won't use the word panic, but definitely there is an attempt to sell and go, whether to cut losses or protect gains. I think markets are in that kind of a mode right now.
Yeah, and one will be in that kind of mode if in a matter of 6 days you lose 32 lakh crore rupees worth of wealth in the markets. And of course, the fact that the mid-cap index is down 9% in 6 sessions, small-cap index is down 11% in 6 sessions, actually a little more than that perhaps, because yesterday itself the small-cap and mid-cap indices were down over 4%, and of course individual stocks have come off 20 to 40%. So portfolio level pain is something which is very, very visible in the market, and that's the kind of capitulation sort of behavior is what you saw, because it's the retail money which is going out of the system clearly. And one can ask why the fall, and there are multiple reasons for it. It is of course that the FIs are not coming back because of the dollar strength. It's the fact that there is that weakness in demand globally that street is expecting, and that could be explained why dollar is on the ball right now. And then uncertainty regarding Trump coming back and what really it means for the policies. All of this is something which has not been taken well by the street, and the earnings so far haven't been great. There have been a couple of news flow about leadership changes and all of that, and the market does not like ambiguity, and it's just falling under its own pressure at this point of time. But Nikunj, where do we go from here? Do you think that the phase of capitulation is something which is towards the end right now, because the small cap index is substantially off its highs?
If you look at the list of where the carnage has been, average carnage is about 25% in any individual group, whether it is a energy group or whether it is the manufacturing group or the microfinance group. So say that there is to say that the trend has not changed. I think the trend has changed both in terms of commitment and also in terms of price action. I see the following happening. I see that markets are extremely oversold. There are extremes in the market which have got created both in terms of market behavior and also in terms of price action. So a bounce could be around the corner. Could it be a shallow bounce or could it be a durable bounce? I would make case for a shallow bounce right now, and then you got to take it from there depending on the global setup and depending on the news flow and what we get from the budget. I see the following happening. I made a template of, or let's look at template of where the bounce could be the strongest and what will change. I think this entire Ringa Ringa Roses which is happening in the IPO market. You remember this game called Ringa Ringa Roses? I think this Ringa Ringa Roses or musical chair which is happening in the IPO market, I think that has to stop. You are likely to see a big reversal in the way how everybody was approaching the IPO market, from pre-IPO placement to selling on the IPO day and then selling it before the lock-in opens. I think this entire Ringa Ringa Roses there has to stop. I see that big change happening. But I also expect that financials will come back because interest rates will come down. Inflation is getting manageable now. So that's one pocket. Second, manufacturing will come back. It's not going to be completely blown away, irrespective of what Trump may say. Consumer tech is still growing, the new fintech companies, the new consumer tech companies, so they will bounce back. They've already corrected. And last but not the least, I think the selling in the power space, whether it is utilities or whether it is financiers or whether it is anything to do with solar, I think that also will make a comeback. So I would imagine that the core of the comeback theme would be interest rates, second would be manufacturing, and the third would be energy. These are the three themes which will come back. But I will stick my neck out and say again, musical chair in the IPO market I think will come to install. So what we saw in 2024 is the amount of, it was not about money raising. Good companies, they go public, fair enough. But pre-IPO placement, then the IPO listing, then selling on the IPO day, and then selling before the lock-in opens, before individual investors come in. I think that had become like a habit. And that chain I think has to break. So I would urge our viewers not to go there, because there I think the music has to stop. So the musical chairs will stop. Please grab your chair, because when music will stop, you'll be out of the game.
Yeah, absolutely. And I was just looking at, some of the large and mid caps and the kind of fall that they've had from their 52-week highs. I mean, it's a stark list. Adani Enterprises, for instance, it's a good 40% from its 52-week highs. Tata Motors, 36%. Adani Ports, 34%. Asian Paints, I can still negate because that's a structural story there and a special situation stock in that sense. But a Coal India, Bajaj Auto, Bajaj Auto, to think of it, I think the last 6 months of 2024, it pretty much has undone all of those gains. It's down about 33% from its 52-week highs. Even within the mid-caps, a Vodafone Idea, 60% off. Cochin Shipyard, 54% off. A Yes Bank, IOB, RVNL, Bank of India, all these stocks have given up anywhere between about 40 to 55% from their 52-week highs. And the list is as stark when it comes to the small caps as well. Raymond, the high and mighty, most revered stock of last year, or I should say of last 2 years, acute high HNI concentration, that also has fallen a good 56% from its 52-week highs.